Welcome, everyone, to today's market commentary and update on the coronavirus and its impact on the market. With me today is our Chief Investment Officer, Aaron Tuttle, CFA. Welcome, Aaron.
Thank you, John. I'm glad to be here.
I'm glad you're here too, because you have more answers than I have. So a lot has happened since our broadcast last week. Yesterday, we had a broadcast actually on the CARES Act because there's a lot going on there with people trying to figure out how they're going to qualify for different funding sources from this new bill, especially to support the small businesses. COVID is tracking on the lower bounds of our internal models as well as others, which you, Aaron, will of course point out in a few minutes. The new deaths will continue to rise, but infections, as we can see, are starting to slow. And the market has responded, so we're up this week. In fact, looking at the S&P 500, the low was just 2 weeks ago at 2237. I believe that was on February 19th. No, that was on March 23rd, 2 weeks ago.
February 19th was the high.
So 2 weeks ago, we were at 2237. We're now, as of the end of today, at 2749. So that's 500 points higher than the low, which is a 20% increase from the low, but we're still 19% from the high. So it just goes to show that it's very difficult to time the market. But with all of this, we've heard some forecasts of a depression. And you're going to explain to our audience why we believe this is not to be the case. And then finally, the primary indicator that we're tracking now is for the recovery, which is going to be dependent upon the length of time that the lockdown lasts. So more on this. Aaron, enlighten us with your presentation today.
Let's begin with reviewing our timeline from last week. We expect to see a flattening of new cases with fewer cases than the day before, despite the tremendous number of tests coming to market, as well as slowing growth of the death rate. We are on track for both of these. The US has done more testing than any other country despite lagging at the beginning. This was due to removing regulation on private labs. There is still room to go since the US is not leading on a per capita basis. Though good news, this has made it difficult to track the change in new cases because we simply are testing more and more people each day. There are ways of removing the noise from the data, and Friday provided evidence we had turned the corner in the US. This was confirmed over the weekend, and we believe it's the reason for the sharp rally on Monday. Thankfully, the death rate is not only slowing, but it's not as high as once feared. Our initial model assumed 100,000 deaths. As of yesterday morning, we expected total US deaths of 24,000 based on our internal models. However, the spike in deaths by the end of the day caused us to adjust this upward to 30,000. This is near our bull case scenario. While reviewing other models yesterday, some are still estimating 80 to 100,000 deaths, such as the IMHE, which is a model referenced by many, including the current administration. The numbers have been consistently near the lower bound of the uncertainty range. When I reviewed the site this morning, the estimate had dropped to 60,000 deaths. This means the economy is likely to open sooner rather than later. Now, we are unlikely to make the early date mentioned for opening the economy. Many may recall that the Trump administration hit it at Easter, but we are also unlikely to go to June. The market rallied based off this information, continuing the V-shaped recovery pattern. Let's get into what is ahead and specifically concerns we are hearing, some of which you mentioned, John. Are we moving into a Great Depression? We do not believe this is likely. However, we think the difference between now and the Great Depression are instructive with what we see going forward. So we want to spend some time on this. The Great Depression was caused by 4 factors: an increase in taxation while cutting government spending, a tightening of the monetary policy, restrictions on trade, and increased regulation. I'm not trying to bore our listeners with economic equations. Maybe I am. But it is my personal belief that science places too much faith in them. But it would be helpful to review the standard Keynesian GDP model when assessing the difference between now and the Great Depression. This is a standard formula, but let's add some images. To review the model, GDP, or gross domestic product, is the value of the income in the economy. This is an aggregate of C, consumption, think demand, I, investment, whether in factories or technology. And this is ultimately done to increase future supply, and G, government spending, as well as net exports or exports minus imports. If we look at global GDP, then we could remove the net exports section. Currently, the Earth does not trade with any other planets, so there is no exports to consider. This will help simplify the equation. Now, let's look at the 4 factors attributed for causing the Great Depression. First, an increase in taxation with a reduction in government spending. Notice the equation calls G government spending. Where does the government get the money to spend? Taxation. But if it was taxation, the equation would look like this. The T's would cancel out. The larger T has a minus sign, so we can see that if the government increased tax but did not increase spending by the same amount, GDP would actually contract. The point of the illustration is to demonstrate that an increase in tax and, with a decrease in spending will contract the GDP. This is not happening at the moment. Governments are spending well above taxation levels. Another observation is that the equation is a closed equation. Any change in one variable must have an equal change in the other variable, or be removed from the formula altogether, with the latter called a liquidity crisis or a liquidity trap. Just like the government, if it was not spending all of its tax money, keeping it in an account, if people were doing the same thing, that would be there. So then, how does the GDP ever rise? Let's move on to a tight monetary policy. The previous equation did not resolve how GDP is able to rise. We must change the equation again by adding government spending, or what we'll call S. But where did this money come from? Well, if the government spends more than it takes in, which it's been doing, it must borrow. This is done through loans. But loans would just reduce consumption investment similar to taxation. It's simply another transfer. This is where monetary policy and the banking system enters into the equation. I'm going to simplify the process by not including the banks. They are mainly loan originators, but part of the overall Federal Reserve System. Think of them as branches. The Federal Reserve is able to provide newly created money by purchasing government loans from the U.S. Treasury. By doing this, they increase the demand for bonds. The bonds appreciate in value, meaning interest rates decline. This is how the Federal Reserve sets interest rate policy. This injection of new money will increase GDP since it is an addition from outside of the formula. Consider the S, new money through deficit spending. Conversely, a tight monetary policy would be to sell the bonds or let them mature and the money gets pulled out of the system. In this case, GDP would decline. The current Federal Reserve is lowering interest rates and purchasing debt. We have a very loose monetary policy. This is unlike the Great Depression. Okay, now global trade restrictions. I'm going to simplify the equation again by removing taxation and any government spending that is not funded by the market economy, as in people buying bonds, because these all cancel out in the equation. I will only include the money created by the Federal Reserve System. We will now bring the net export section back into the equation. If a country is a net exporter, then the number adds or increases GDP since the positive sign is on the exports. If a country is a net importer, it subtracts or reduces GDP. Now, there is a capital account component elsewhere, but this is already technical enough, so I didn't add that here. During the Great Depression, many countries tried to increase their GDP at the expense of other countries and put tariffs on foreign goods to try to shift economies to be net exporters. However, all countries were doing the same, which essentially slowed global trade and increased taxes and contracted the overall market economy. It is true that there are some trade disputes at the moment, but overall, the global economy continues to increase trade. Hence the global supply chain issues mentioned in the previous week. Though present, these trade disputes are minor. We are near all-time highs in global trade numbers. We do not think this rises to the level of the Great Depression. Let's move to regulation. If all of this seems to be a bunch of accounting tricks and not reflective of the real economy, you are correct. To prevent the market from adjusting to the realities and ignoring the accounting tricks, regulations need to be put in place. During the Great Depression, the government put in place several items to slow or prevent changes in the income earned by workers. Another example was outlawing gold. Prior to the Great Depression, you could exchange your US currency for physical gold and or silver. The possession of gold was outlawed. Now, we have seen some calls for increased regulation, but we've seen more regulation removed than brought into law. Removing FDA approval for the COVID testing is an example. Lessening regulation on the manufacture of surgical masks. Allowing Uber drivers to deliver alcohol drinks. So why not always run deficits and have the Federal Reserve send checks to everyone every month? This gets us to another concern we've heard, inflation risk. Another equation may be helpful. We are leaving the Keynesian school of thought and moving to the monetarists. They too have an equation for GDP, but this one better captures the central bank role. MV equals PY. M is the monetary base, or how much money has been created by the banking system. V is the velocity, or how the money will be spent. I like to think of it as a fear or greed index. If you're concerned about having sufficient cash or believe prices will drop, you're less likely to spend the money into the economy. If you're confident on your future cash flow or believe prices will be higher, you're more likely to spend your money. Y is the real economic production, the actual goods and services created by the economy. It is not the price. P is the price paid for those services. As an example, if the economy had one hammer, Y, and it sold for $15 trillion, P, then we would need a $15 trillion monetary base, M, to meet this transaction. And it would require one transaction, V, with that $15 trillion of cash. If we sold two hammers at $7.5 trillion, then we would still have 15 trillion GDP, but only need a $7.5 trillion monetary base, but the V would still need to be 2. Let's take the $15 trillion monetary base, then only half the cash is actually needed, so V would be 0.5. Okay, so if money supply is stable and the real economy is increases due to greater production, then there are more goods relative to the amount of money. Assuming velocity stays the same, we would expect deflation. If the money supply is rapidly increased and velocity stays the same, and the economy did not grow as much, we would expect to see inflation. Now, V is related to human psychology, so it's not easily changed by the powers that be. It's based on our collective actions. Hence, the money supply is the direct lever for the Federal Reserve. The goal of the central bank is to match the increase in M to Y, so we get stable prices. Actually, they try to have some inflation, and that's where we get that 2% inflation target. Now, previously, we mentioned the size of the total stimulus package is 25% of GDP. And we know why the real economy has not increased by 25%. It has dropped since the economy has been furloughed. This does not necessarily mean an increase in P or price of goods. People may not spend the money and B drops to offset the increase in the money supply. This actually happened in 2008. Or the new money could spur additional investment and production capacities increase rapidly. This also happened in 2008 with efficiencies gained by technologies. One example would be the increase of the supply of oil due to fracking. Do we all remember peak oil? Nonetheless, 25% more productive seems like a pretty high hurdle. We believe inflation is a real risk. I hope heads are not hurting at this point. The banking system is odd, and mathematical formulas are for the geeks at heart. So I'm going to move past this and talk about what we are doing about these risks. The Great Depression did not just fall out of the sky. The 1920s saw a very loose monetary policy as the British pound was losing its reserve currency status, and the increased production of the mass industrial era was hiding the monetary inflation from showing up in P, the price of goods. Just think of how many new inventions and how many new things were coming out of the economy in the 20s to include the automobile. Now, I mentioned the gold restrictions earlier to allude to the inflation that was happening in the 20s. Ultimately, the Depression needed to happen. This was the cleanse from the roaring 20s monetary inflation. However, it did not need to be so severe. We believe a similar phenomena is happening now, and it's important to plan for a Great Depression-like event. However, we believe the Depression is still a decade or more away. We expect a robust response from the market as we continue to automate and offshore production in the US and add to production through technology. The greater risk at the moment is inflation. Now tune in for a continuation of this theme during our next updates. So once again, what are we doing about this? Going forward, we are favoring assets that will do well as inflation hedges, and lowering the exposure of securities that would not do well, specifically bonds that are paying very little. We expect to continue these weekly updates. We've heard from many of our clients that they appreciate them and they get value from them. As the market volatility decreases and we build out the process of sending up these ongoing updates, we will try to deliver them via video so you can listen at your convenience, and those that are not able to tune in can also hear them. However, during the volatile markets such as these, they will be live. One, we do have to go through some compliance to get them approved, and things change so fast. We want the information to be relevant and timely during those times. And we want you to be able to have questions and answers live. Now on this, we anticipate the format to be as follows: a current update on the market and economy, a reminder of the theme that we just discussed and whether the economic indicators, how they're doing. So we're essentially testing that theme to make sure it's still relevant. Technical and fundamental indicators, which help us make changes in strategies, strategy performance, recent changes in the portfolios that you've seen. We also hope to interview some of the fund managers within your portfolios so that you can be familiar with them as well. Finally, planning implications based on these updates. Though we view this information on an ongoing basis, the investment committee will be putting this together in a comprehensive and relevant manner for you. Let's take a sneak peek at a slide for inflation risk. M2 money stock is the top left-hand corner. The last few weeks, it resembles a hockey stick as the Federal Reserve injects new money into the economy. To the right, velocity of money has slowed since 2008 from a multiple of 2.1 down to 1.4. The CPI has been rising over the last year to be above the Fed target, which is 2%, but has recently slowed with this correction. However, this is a backward-looking index. Instead, subtracting the 10-year U.S. Treasury inflated protected securities from the U.S. Treasury gives us an inflation expectation going forward. Also, we will be showing under and overweight asset classes. We put on gold in some portfolios a few weeks ago and mentioned we are underweight commodities on the last call. This is still true for a broad basket of commodities. However, gold was categorized in the other category. We believe it should be categorized as a commodity and made the adjustment to our underweighting call.
Wow, that's a lot of great information. Thanks, Aaron. Actually, I feel like maybe our listeners should get at least one credit hour towards their economics degree if they're pursuing that at this moment. But that's a great summary of the different economic theories and how they impact our portfolios. So one of the things I want to ask you was, can you comment on the shutdown length and its impact on the recovery speed or shape?
Yes. So the longer that the lockdown is in place, the more of a U-shape or even possible L shape that we will see in the economy. That means that the longer that we're locked down, the more detrimental it is to the overall economy. There is a wide range of projections, similar to the wide range of projections of when we actually peaked in the coronavirus. As I mentioned in the presentation, there was one time rumored that it would be Easter, and that just seems unlikely at this point. There's a lot of pushback because we still want to get the economy open sooner rather than later to prevent any serious damage. Most companies only hold a couple of months cash, at least the small businesses. So if they're burning through that cash, they're going to go out of business if that cash runs out. So sooner the better. And there has been ideas such as testing individuals, and if they test negative for the coronavirus, they would be allowed to go back to work. Obviously, there's some civil liberties that would have to be overcome at that point. But it does not, most do not assume we'll be past June 1st. And as long as the death rate is lower than expected, and we continue what looks like the top of this peak, we begin on the downside, and that there are no second waves elsewhere, I would assume that it's going to be sooner rather than later.
Well, another question we have is that it says lower interest rates are killing, this is their word, savers, especially retired savers. Isn't money devalued with such low interest rates? How do we get out of the low interest rate cycle? I know that we've been commenting on the fact that bonds are risky right now.
Yes,
and there is low interest. We've been moving more towards cash-like instruments. And the purpose of bonds in the portfolios is not the yield as much as it is to manage the volatility of the equities.
Well, I certainly don't mind the rhetoric of killing the savers. I agree with it. The Federal Reserve is coming in there and buying these bonds instead of the overall population, especially those that are in retirement, and they could be getting much higher yields than they're currently getting. I think this causes a lot of price distortion in the market. And there probably isn't a more important number for economic planning than what the real interest rate is, because it's time preference. It's how do we measure what we should be doing now and what we should be doing later, and what's the value of those economic goods, whether you're investing for future production or you're consuming now. So by continuing to keep interest rates low, yes, it deprives those that are savers from being able to get paid for the bonds, especially those that are in retirement and just don't want this market volatility and would like to have a steady income stream that has a lot of guarantees around it.
Yeah, but it's interesting that, I reflect back on how we were planning for clients back in the 90s and even my own parents' experience. So they were depression babies, and they saved all their money, and they were literally living on the interest from their CDs. So they expected to get 4, 5, maybe 6%. And then 2001 came along, and they saw their 5% interest rate drop down to 0. They had to start eating into the principal. Goes back up, and then 2008 hits, and it goes back down to 0. And then they eventually ran out of their money before they both passed away.
Right. And this is at a time now that we see where the interest rates are, and inflation, yes, since 2008 has been low, but a lot of times the rates on the 10-year is lower than the inflation number. So you know you're losing money just on that index.
So going to another question. Have we hit the bottom yet? I know that we said that February 19th was the low, and we've come back 20% from that. But the reality is that there's still a lot of variables out there that we don't know. And I think that one of them, of course, is going to be how long this lockdown takes place, and is there another variable that we haven't seen or expected or thought of yet that could cause it to go down further?
I will go out on a limb and say most likely we've seen the bottom. What could cause that to change?
Yeah,
obviously, any other exogenous event, some black swan that we have no idea that could be coming, that certainly would hurt. Or just this second wave where it looks like we're going to shut down, and maybe like the not the swine flu, the Spanish flu. The second wave of the virus is far more deadly and attacks more. The area of highest risk is in the younger population. There is historical precedent of that coming. So, but if you just ignore those possibilities and we just go with the current environment, I think that it is more likely than not that we've seen the bottom of this correction.
So on another matter, can you comment on the oil situation? Because if you think just a year ago, things were pretty normalized and going very well in oil worldwide. And we were doing very well here in the US. I mean, you were having a decline in the number of actual refineries being built, but you had an increase in the production, which is kind of interesting. So what can we expect going forward with this second black swan that we talked about last week with the oil?
Well, it's hard to tell until once the market begins to truly start pricing that out and looking beyond the lockdown, we'll start to get that collective wisdom of the market to have a better understanding of what direction oil will go. All of that information is not being paid attention to, so it's not getting in the price of the markets. It's not really being talked about. So it's really hard to get a feel, but we do know that is a component that still needs to be priced in and understood. One of the big things is just how much oil the U.S. is able to produce. So we're talking about in 2008, peak oil, that we were going to run out of oil. Well, that's certainly not the case. We have so much oil that there have actually been places that are paying people to take the oil from them because the storage cost was higher than just paying somebody to take the oil. That's certainly not a sustainable business model.
No.
So there's going to be a lot of back and forth and trying to figure out who needs to shut down and what actual output is. And then we still have to figure out what demand's going to be as the economy begins to start back up. Oil it's not just that we have a lot of supply. The demand has dropped off because hardly anybody's driving. I was on the road the other day going to the grocery store, and it was basically deserted. There was nobody out. One of the reasons that we're underweight the commodities, whenever we look at it as a broad basket index, which is the way we've typically looked at it, that index is almost 30 to 50% of it is dominated by oil. And we just think there's just too much uncertainty around the price of oil to say whether we should be bullish on it or not. Somebody's going to make a lot of money in oil, though, at this price. We just think that there are other places that have more certainty and attractive returns, such as just basic equities, and for more defensive position that could do well in inflation with inflation hedge. gold. So we favor those over oil at the moment. However, we did put in a chevron and wide mode through this correction because it has a wide mode. It is paying a strong dividend, may get pulled back, but we did like that for the portfolio just to try to get some exposure because these are definitely prices that are fire sale prices.
So we have another question here. As the economy reopens and global trade increases, what kind of retaliation do you expect from the EU, the US, and others against China, which is a major exporter to the rest of the world?
One of the things that is probably unlike the Great Depression, where you had problems with the overall economies and people were bringing a lot of stuff back, they were still fairly self-sufficient. Now, the difference today is it's really difficult to retaliate against China. One example was the pharmaceuticals, and they have their own propaganda against the virus. They've actually blamed the U.S. as creating the virus. And then they promoted—
the U.S. is blaming them.
Yeah, absolutely, absolutely. But one of the things they mentioned and how gracious China is, because while they were in the lockdown, they kept their pharmaceutical factories continuing to produce the medicines, and said that even though the U.S. has put trade restrictions on China, now China's put trade restrictions on the U.S., but they didn't cut back their antibiotics, and 90 to 98% of the antibiotics are coming out of China. So
that's a large.
It is a large, and you know that
tremendous interdependence.
Yes, that's exactly right. So there is this interdependence that has never before been seen that's probably going to lessen. I'm sure all the pharmaceutical CEOs' heads perked up on that comment whenever there was basically a hint of weaponizing the manufacturing and production through the global supply chains. And that's one of the reasons that we say that you're going to have this onshoring back to the U.S. is because of these risks. Right now, the global economy is just too intertangled to really deal with these in any straightforward and effective manner.
So we had talked about one of the purposes of these calls is to talk about changes in our portfolio. And we had talked about how U.S., we believe, is going to be the economy for the next decade. Mm-hmm. Have we, or how have we changed our investments in the U.S. equities versus the rest of the world throughout this crisis?
We, in tax sensitive, we no longer have international exposure in the portfolios. And that was moved to a U.S. large cap fund by MFS. We have as we stated before, we are underweight international. We're underweight real estate. We were underweight the broad basket of commodities, but that's more neutral now that we consider gold the commodities. And we were underweight real estate because it's hard to distinguish the retail real estate from the other real estate, and we think that there's a lot of headwinds there. So we have been making those changes, and we were already pretty much there. But we anticipate these being strategic allocations and making additional changes. There are trades actually happening today to continue that move towards bringing emerging markets to neutral, making sure we have a significant overweight to U.S. large cap, reducing that international exposure and real estate, and also considering the moves away through fixed income, because we do believe and hope that we've seen the bottom of this correction.
So when we talk about the U.S. equities versus the international, one of the things that's a little tricky is the fact that many companies are global.
Yes.
So in other words, you have companies that were U.S. companies that moved out of the country because they wanted to have better taxation, or you have companies that are large where the majority of their customers are U.S. Mm-hmm. So how do we distinguish among those players as we think about this dominance in the U.S. equity markets going forward?
Well, one, we're confident and not concerned that we're violating diversification principles by having an overweight to U.S. large cap, because so many of those companies derive a large amount of revenue overseas. I haven't seen the index since this correction, but it's usually a little bit more than 50%. So the index itself is a globally diversified account. And to your point, large global companies don't just reside in the US. Unilever is in the United Kingdom, and it is just as, there's no reason to favor Unilever over Procter & Gamble. They're both fine, great companies that have revenue that's derived across the globe. We have historically had a lower tilt towards international, and the holdings that we had were the global 100. So they would have included some US global companies, but also international global companies.
So you've commented on that now is the time to take risk on equities, right? Yes. Because everything's down in price. At what point will we start to think differently? And I'm thinking in particular because risk is different to consider today when bonds also have the risk. I know that we're trying to mitigate that risk by being short duration, having cash-like instruments. But how will we monitor this risk-taking or risk balance as things recover or get back to where they were prior to this big correction?
Well, the main thing is, this was an exogenous event, so they did not give us indicators that the economy was slowing, because this was not caused by the economy slowing. It was caused by a virus arriving, and then you had the oil issue, and then the Federal Reserve and the government's reaction to that. So none of that showed up in the data. But typically, we do get a warning in our technicals that the market is slowing down, it's peaking, and it would be good to go defensive. In addition, we like to view the money supply. Many long-term listeners know that we see that as a key indicator. And right now, if we were to look, we typically see somewhere between 6 and 7% annualized growth rate on the money supply around this time in the season. If we just look at last week's growth, that was an annualized 124%. Now, they're not going to print that way the whole time, so we know that's not going to be realized this year. But we think that injection that the Federal Reserve is putting money into the market is a good indicator on the risk of serious corrections. It's by no means perfect. This recent example is an example where money supply was very high and robust prior to this, and we still had a sharp correction. So there's no way to determine for sure that that there's not a risk for a correction. But we've talked about our cash hubs. That's ultimately how you protect against the market being wrong. But what we do know is you're not going to get paid to hold bonds. They're well below the inflation, and inflation risk is now higher. It's yet to be seen, but it's now higher. So based on principles, those bonds are overvalued. And we know equities are undervalued relative to fundamental analysis. So we just take that logic to say, well, then equities, though more volatile, long-term, are going to be a more conservative play. The problem then is, once again, that you do have these corrections, and that's why it's so important to have that cash reserve set aside, because we just don't know when they're going to show up.
So one last thing is just thinking ahead to the next week, what we're going to be looking for, because what we do know is that death rates will be rising just because they lag the new infection rate. People are still going to be shut in, so there's going to be a lot of emotions going on there. Will that be reflected in the market at all? And what are the things that we're going to be looking for in terms of understanding where the market is or relative to this virus?
There were several questions in there. Yeah.
Just answer more globally, and then that'll satisfy.
Which one are you specifically asking?
Right. So first of all, this week we're going to have increasing death rates, right? Because that lags the new infection
So
rates.
on the death rates, we are seeing a flattening. Now, yesterday we had a good jump from that, but whenever we look at where we would have anticipated based on the growth rate, there is a lot fewer deaths than what was expected. So that's one of the reasons that we've had the rally. That doesn't mean that it can't pop or whatever, but it may have a lot to do with the fact that there was a lockdown. So there's been less spread than what would have been otherwise.
People are still going to be shut in this next week.
Yes.
A lot of emotions. Will that impact the market at all? Because there's one more week that people are furloughed.
So the market is a future index. It's trying to price in what's going to happen in the future, not what's happening currently. And Monday's rally, today's rally, we did have one yesterday that was sold off. A lot of it, I think, is because of an increase in deaths that was not anticipated. So yes, of course, it will always affect things, but it looks like on net, we're getting closer and closer to the lockdown being removed. So the sooner, the better and the less impact.
And so what will be the things that we're going to be looking for in the investment committee, just sort of planning through between now and next week's call? And I don't want to be short-term focused. It's just that this is a unique circumstances and people like to know what are we looking at now?
One area that we think is off the reservation that a lot of people are not in the market that are not looking at is when schools are going to open up again, especially the schools that are in impoverished areas. Impoverished areas, those children are often very dependent upon the free meals that come out of the schools, and the state governments are very aware of that. And some of the areas that have been hit hardest, Ferguson, here in St. Louis, those teachers are already getting announcements that they will be opening back up on the 24th. Now, whether that is across the overall economy, probably not. That's probably whenever things begin to relax. But that's one area that we're trying to be creative to try to get some of the inside scoop and rumors, because the government is going to be the first to know. So we're paying attention to that. So I would say that that's our big non-market. Everything else is kind of headlines. Everyone else is probably reading the same headlines, so I would just repeat what we all probably know. That's our insider baseball. And then there's a couple of other sources that have been reliable through this on getting information and rumors that have originated in the government as well.
I think that's a very, very good point, because otherwise you don't want these children starving out
there. Right. And most of those schools, they're delivering the meals as a delivery program. The teachers are taking them breakfast and lunch to replace those meals. However, those are also, especially because of the culture, they tend to be more close, as in physical proximity with each other. So they've been some of the most hard hit in the region. So.
Yes. Well, Aaron, thank you so much for that very enlightening information, as usual. It's been amazing. I know it took a lot of time and preparation for today's broadcast. So thank you to our listeners for listening in. And if you have any questions at all, your lead advisors and associate lead advisors are available. And we look forward to speaking with you again next week.